Hi everyone, I hope this latest edition of the Financial Planner finds you all safe and well. We come off the back of the government announcing last night that we face a further 3 weeks of lockdown, and I guess none of us really believe that that will be the end of this current period of isolation. So we continue to be in it for the longer run, and therefore we're going to continue with these educational videos which have been so well received, and hopefully shed some light on some further thoughts, planning ideas and things that we should all be doing, I guess, in this downtime that we have. Thanks also, can I just take this opportunity to all those people who have texted, sent emails, rung to ask how we as a family are, to check in on the Pencil Wealth Management team in general. I know the guys in the team are very appreciative of that, and I'm pleased to announce that everyone's in good spirits. Very busy, I might add, but all healthy and well. So thank you for those who have taken that time to do that. It's much appreciated. Today I'm going to use the video to focus specifically on questions that have come in with regards to fund management. And a lot of questions are around what are our fund managers doing at this time? How do we as advisors communicate with them? And what changes and defensive mechanisms are fund managers taking to not only take opportunity, the bull by the horns, if you like, in periods of downturn to look at where opportunity will come in the medium to longer term, but also what are they doing about defending you against any further volatility that might come as a result of this ongoing crisis. So I'm going to try and cover off a few of those questions now. I hope this is useful as always, and welcome your questions that come back in. So the first question we're going to look at on screen now is that of what is a fund manager doing in terms of activity in a turbulent market. Now, this is a really important question because in terms of activity, of course, every fund manager in your portfolio will view this scenario slightly differently. There are some fund managers who are now holding less cash than they've ever held before because they are effectively seeing this as a buying opportunity, looking for undervalued stocks that they think over the medium to longer term will offer real value to you as an investor. Now, of course, we're human beings, so we just look at current day-to-day values, and that is, again, the emotional side of investing. Whereas a fund manager, and I've explained this to a few clients recently, is more like a clinical surgeon. They are void of emotion. Their pure remit is to look for output, for end product, for where we can be by a certain period of time. And they don't get involved into the day-to-day volatile human response of what a market conditions can bring. So sometimes that's quite hard to understand, but actually what you want. So a lot of fund managers will view this as a period of opportunity, and many have actually commented that they could really do with a recessionary period every couple of years to really give you good returns. Of course, none of us want that, but that is their mindset. So I want to give you a couple of examples of specific fund managers and what they're doing. So I referred to International Equity, and you can see their current top 10 holdings now on screen in my previous video. And particularly when we refer to Hamish Douglas and the Magellan Fund, which is International Equity and will be in a large number of your portfolios, this fund has done particularly well in this period of downturn. As I record this video, they're down 7% year to date, which I guess sounds again a little bit silly to be talking about a fund that's down, but if you compare that downturn in its size to most major indices such as the FTSE 100 or the Dow Jones, etc., you'll understand how that has defended itself significantly well. Now, there's a reason for that. You can see in the portfolio there's no exposure to oil, there's no banks, there's no emerging markets, there's no airlines, for example. So the way that portfolio has been positioned, particularly into companies like Microsoft, Google, Alphabet, Facebook, is in a way defending itself against the recent volatility. Hamish himself is quite keen to stress this, and he's talked about the fact that certain companies that they took a vision with how the world's evolving prior to coronavirus, and he really believes will come true afterwards, is because they're concentrated in the areas where we're now all going to evolve. For example, video conferencing, such as what we're doing now, productivity software, entertainment streaming, online shopping. Now, all of these things were relatively big prior to the coronavirus outbreak, but I think we'll all agree it's going to change how we all consume and absorb information, and therefore he thinks he's really well positioned to take advantage of that once the turn comes. Now, giving you an example of what Hamish has done in international equity, I talked about how much a fund manager holds in cash at this time. Now, in January of this year, Hamish was only holding 6% cash in that fund, so he had very little liquidity in terms of how much defensive stance he took. He's now increased that to 16%. So if that gives you a better feel for what he's done, he's clinically removed, in his words, certain companies that he now believes are at the top end of their value, or effectively in fear of being under pressure by the most recent scenario we find ourselves in, remove them from the fund and increased his weighting into cash. That gives you a more defensive position at this time, but equally gives him opportunity, when opportunity arises, for him to reimburse that cash back into the market and purchase shares that he think will offer real value. I'm going to give you another worked example now, because I think these are useful. We're now going to look at equity income. And this is Nick Purves' fund that you can now see on screen, and some of the changes and specific companies that Nick Purves has made over the recent weeks. Now, two interesting companies that Nick has actually decided to sell out of the portfolio. He's sold GlaxoSmithKline and he's sold Tesco's. Now let's deal with Tesco's as an example. Why on earth is a fund manager selling a supermarket when all we can see is people panic buying much more than they need, supermarkets taking on much more staff and effectively going to record much bigger profits? Now actually, this is where a fund manager comes into his own. What Nick is looking at is the fact that prior to COVID-19, Tesco's was actually about to reduce numbers of staff, reduce numbers of stores. It was actually on a streamlining of its business, and therefore he perceived that it wasn't actually going to record the profits he would want as an investor. He doesn't believe this short-term increase just due to the scenario at the minute is a good enough reason to hold it, and equally sees it as an opportunity to sell it. Why is that? The price is being driven up by private investors thinking it's a good stock to buy, and therefore he believes he can sell it now at a premium and effectively make a good return for you as the investor. So that makes eminent sense when you think about it that way around. What's he bought instead? He's bought ITV. Now, even more interesting, talking to Nick this week, ITV was devalued by 55%. So the share prices had dropped 55% recently, and he's purchased them. Now, that's not just because on a whim that they're low in price and therefore surely they'll go back up. He actually believes that was far too big a devaluation of where they should have been. He actually thinks they should have been devalued by circa 20%, and therefore he thinks the growth to come back is immediately circa 30 to 35%. And not only that, of course, he's looking at trends. What are we all doing at home? We are sat watching the television, consuming data and information. TV channels such as ITV, who have got advertising revenues, he believes now will be on an upward trajectory due to the fact that advertisers are looking for that prime time space. And he thinks that that offers a real opportunity for that company to do very well. So again, a nice soundbite, which we have plenty of these examples to give with you, and I'll share these over coming weeks and in our one-to-one conversations, but an example of how a fund manager is being proactive. The last question I want to touch upon is what are we doing in terms of communicating with fund managers, and how often are fund managers being held accountable? So if you remember, the investment committee that we have at St James's Place traditionally would sit in front of all of our fund managers across your portfolio every 2 months. Now, the drastic nature of the times that we find ourselves in is that has now been changed to a weekly basis. So they're not seeing them in person, so before anybody panics, it's all been done through modern technology such as this, but each and every fund manager in our portfolio now is spoken to on a weekly basis. And what's happening in those investment committee meetings is an understanding of what they've bought, what they've sold, what stance they're taking over certain geographical areas, what views they've got about certain industries, and how they're reflecting on governments around the world and their fiscal policies. So that's really important to you as the investor. That tier of information that's in the middle of you not having to make those decisions or do that research is what's happening behind the scenes. Of course, myself and all of the team, Emma, Alan, Belina, and all of our Peninsular Wealth Management team digest that information on your behalf. We're sat here sometimes at midnight listening to fund managers across the world, and then we're able to put that into common sense strategies, evolve your portfolios accordingly, and have sensible conversations about your own personal situations and attitude to risk. So hope that's a useful feedback for today. Hope that gives you a bit more certainty about fund managers and some of the ideas that they're doing. Clearly these videos could go on for hours and hours and hours talking about different examples of what fund managers are actually doing. But I think the key thing to remember is timing, like we said before. If we've got timing, the world will recover. It really just presents opportunity and fund managers are seeing that. But of course, what we all want to see as well is recovery in the shorter term. Stay safe, stay well, and all the very best for now, and I look forward to catching up with you soon.